Corporate finance practice problem using OneNote. Net present value NPV with closing cost. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side in the practice problems, down in the 1225 net present value NPV with closing cost tab. Also note, when using OneNote, look at the immersive reader, because many of our presentations up top will be mirrored in the text area, having transcripts, same name, same number down here with transcripts that can be translated into multiple different languages, which can be either listened to or read in them. Closing the icon, information up top, calculations on down below, net present value calculation. This time, new thing, closing costs. So we have the negative closing costs at the end of the job to close up the job in some way, shape, or form. Will that mess up our present value calculations? It shouldn't cause us too much problem. Note that it's happening in the same year, that last year that we're closing it up. So we'll have to take that into consideration. So the overview here, remember net present value, those are the types of calculations we want to be putting into place in this typical scenario where we put down an investment up front. We're going to get money back in the future, years into the future, long-term projects. Therefore, we want to take into account time value of money, net present value, internal rate of return. Those are our primary tools in order to do so. So this could be an investment type of project, putting money into equipment that we're going to use to generate revenue, putting money into inventory perhaps, or projects that we think we're going to get a return on. 100,000 being put down, cost of capital. This is going to be what our required rate of return is in essence, and it includes in it not just interest rate. Typically, it's going to include our opportunity cost of the next best project. This is the return that we want to get. Therefore, if the net present value calculation is over anything over 1, basically, over 0 or above, that means that we have cleared the 12%, and therefore we might take on the project because that 12% includes basically the return that we expect to have on it. So then we have the cash flows on down below, which is going to be year 1, 27,000, 2, 36,000, 3, 40,000, 4 is the 60,000. So we have different cash flows here, so we can't use present value of annuity calculations. We got to use present value of 1 calculations. And then also at the end of year 4, we're going to have this cost to close things up. And you can imagine something like you got to, scrap the equipment or something like that, close up the shop, fill up that big toxic hole we've been digging for the last 4 years. Just kidding. We didn't dig a toxic hole. We're completely environmentally sound. But in any case, we got some kind of closing costs at the end, which could be a typical type of scenario here. So now let's do our present value calculations, and note that that closing cost is also in the same year. So we got to be careful that when we set up our flow of payments that we make sure that we pick up the proper year. So we're going to say period 0, that's the 100,000 we put in. Period 1 year away, we're just going to have the 27,000, the 36 year 2, 40,000 year 3, 60,000 year 4, and then year 4 over here also we have the 25,000. Note at the end of this flow assumption, we're going to have to present value both of these. Some people might represent their present value calculations a little bit differently. For example, you might net these two together and present value the net of them. You can do that. You have a little less detail to do that, but you can do that as well. Some people might group together the negative numbers so that they want to group together the outflows and the inflows and then subtract them out. You can do that. But I tend to think that just from the ease of entering it into something like Excel, which is probably the best place to do a calculation like this, considering the fact that you can't really apply a standard worksheet analysis as easily with a mathematical problem. It would take kind of a long time to do that. You could take a long time. Tables would take not too bad, but you still have to look up the tables to find these out. So Excel's probably the way to go. And if you set it up in this format with the numbers on the left-hand side, then you can do your present value of an annuity calculation on the first tab, copy it down quite easily. We do this problem in Excel, so if you want to take a look at that process, you can do so. So first, we got the present value of this item, which is obviously 0 because this is at time period 0. I'll still show the calculation in Excel just to show that I would still do the calculation so that I can then copy it down and have this whole column uniform so we know exactly what the whole column is in essence doing. So it would be negative present value of the rate being the 12% up top. Note that you might hear this rate called the discount rate, the cost of capital, the required rate of return. You might hear it called the hurdle rate, the rate we need to clear. And then we have the number of periods, which in this case is 0, and then comma, comma, and we're picking up the value, which is the 100,000. So we have that item. Note that if we present value this first term, which isn't shown here, would be a $ before the B and the 5, then we could copy this reference down easily, and everything should copy down properly, all the other cells moving down. Take a look at Excel if you want some more information on that. Then if we present value the first payment on year 1, the year 1 payment, present value of the rate, which would once again be the 12%, comma, number of periods is now 1, and notice how I can take this formula if we used Excel instead of hard coding the 1 in our formula, because that would make it so I can't copy it down. And then we have comma, comma, the future value would be the 27,000. If we discount that back using 12%, which includes not just the cost of money, inflation, but it includes actually our return on it, we get to the 24,107. If we do that for year 2, the 36,000 pulls back 2 years to 28,699. Year 3, the 40,000 pulls back to the 28,471. Year 4, the 60,000 is the 38,131. And then in year 4, again, note the same year needs to be processed here, making sure that we don't, pull this out to year 5, because it said it was at the end of the year 4 that we pay this cost. Then we have the 25,000, same calculation, even though it's a negative number. We take the rate and then comma, the number of periods, which is 4. That's going to be the key point. And then comma, comma, the future value would be the 25. We discount it in the similar fashion, making sure we have the signs going the right way. Then if we sum up this series of payments, we get to the 3,520. That does not mean that we're simply making basically 3,520 of profit after accounting for, say, inflation, the purchasing power of money, but rather that anything that would be positive means that we have cleared the hurdle, in essence. We've cleared the cost of capital, we've cleared the discount rate, the required rate of return of 12%, and therefore might take on the project due to that. The fact that this is over 0 means that we got something higher than the 12% return. We could calculate exactly what that was by looking at the internal rate of return. We're not going to focus in on that now, but just be aware of that. Also, just realize that, again, you could see this grouped together in different ways. So if you wanted to present this, you might then say, I'm going to take the 60,000 minus the 25,000 and look at the net result that happened here, right? The 35,000, present value the 35,000, and you'd get the net of the 38,131 and the 15,888. So that if you have a complex series of transactions that's happening from year to year, for example, then you might take the net cash flows from those transactions and then present value them in that format. And again, you also might see this presented as basically the amounts that you're putting into the project on a cash flow basis, the 100,000, the 15,888, and then the inflows. So the inflows that you're receiving from the returns on the project, and you can format it in that way as well. I think this is the easiest way to structure it. Although this last one, you could net that out. That would be fine as well, just because it's as easy to set up the table and do the calculation within Excel if Excel is what you are using. And I think Excel or an equivalent spreadsheet program would be the easiest way to do these calculations.